You must invest your money if you want to stay ahead of the financial curve. And because you worked hard for your money, you want to make the most of it. But how can you make the most of your investment? Don't worry, Upstep Financial is here to help, and we have sound advice you can rely on. Please subscribe to the channel and enable notifications to be notified of every upload. Let's get started with our video now. You must save money regularly, invest consistently, and learn to stay the course for as long as it takes to build a substantial investment portfolio. However, several ways might help you increase your investment returns over time. A handful of these tactics are highlighted in this video, so please keep an eye out. The first way is to check for low-cost investment opportunities. During bull markets, it's easy to overlook investment fees, especially if you're gaining money. However, the financial impact of such charges can quickly mount, and not in a positive manner. Even a 1% reduction in expenses can make a significant difference in the long-term success of your investment portfolio. Let's imagine your portfolio earns 10% per year on average, but you pay 2% in investment costs of all kinds. You'll end up with an 8% net return on your investment. After 20 years, a $100,000 portfolio will have grown to $466,097. Your effective net return will increase to 9% if you can decrease your annual investment expense in half to only 1%. If you start with $100,000, your portfolio will rise to $560,440 in 20 years. That's a difference of about $94,000, and it's all thanks to a 1% reduction in investing expenditures. Expenses for investments do matter. Look for an online broker with a low or free yearly charge, as well as lower transaction expenses to get the best deal. Funds are preferable to individual stocks because you won't be trading them as often, and no-load funds are preferred wherever available. It's time to get serious about diversifying your portfolio now that you've chosen a lower-cost option. The importance of variety is something that most of us are aware of. During a bull market, though, the principle can easily be forgotten, just as it does with investing fees. After all, in a rising market, having a disproportionately big equity allocation can help your portfolio perform better, at least for the duration of the bull market. But there's a catch. Bull markets never last. Anyone who has been ignoring adequate diversification over the last few years should be alarmed by the August mini crash. Markets decline considerably more swiftly than they rise, necessitating extensive planning ahead of time, and that is what diversification is all about, being ready for the unexpected. Maintain suitable percentages of your portfolio in both fixed income investments and cash equivalents, regardless of how well your stock allocation is performing. In a low market, they'll help you limit the losses you'll incur on your stock allocation. It's crucial to remember that limiting losses in a bear market is just as important as maximizing gains in a bull market. You should be rebalancing regularly by now. The goal of rebalancing is to restore your portfolio's original level of diversification. If you originally planned to invest 60% of your portfolio in stocks, 30% in bonds, and 10% in cash, it's time to rebalance if your stock allocation has risen much beyond 60%. In a bear market, the same is true. If your stock allocation has fallen to 40% as a result of the market's decline, you should rebalance to raise your holdings. When the market recovers, you'll be able to profit from the gains. Now is the time to take advantage of tax-advantaged investing. Income taxes on your investment earnings, like investment expenses, have a significant impact on the success of your portfolio. While it's not always possible to eliminate investment taxes unless you're investing in a tax-sheltered plan like an IRA, it's certainly conceivable and vital to reduce them as much as possible. Avoiding extensive trading is one of the greatest methods to do this. Capital gains are the consequence of trading, and capital gains are taxed. These taxes, together with all of the trading expenses, can result in a portfolio that performs no better than a buy and hold strategy that is predominantly invested in funds. When it comes to funds, index-based exchange-traded funds are the way to go, ETFs. Because they are linked to the underlying index, these funds only trade stocks when the index changes. As a result, they trade stocks far less frequently than actively managed mutual funds. This reduces your capital gains and, as a result, your capital gains taxes. Isn't this discussion getting better? So go ahead and keep watching. You can count on us. If you have any clarifications or video suggestions, please leave them in the comments section below and hit that thumbs up button. Let's move forward with our discussion. You should now turn off the experts. Have you ever heard an expert confidently predict that the Dow Jones Industrial Average will rise to 25,000 or plummet to 5,000? Don't pay attention to them. Claims like these are made by experts who are little more than crystal ball gazers. They don't know where the market is going any better than you or anyone else, but they think they do. That isn't to say they aren't dangerous. They may readily catch your attention because they deal mostly in hyperbole. After all, no one wants to be caught off guard while significant things are going on. And if a self-proclaimed expert can present himself as credible, you could just believe he knows what's going on. If you want to be a successful investor, especially over time, you'll need to learn to shut out this type of noise. It only serves to divert your attention away from your financial objectives and techniques, which will not benefit you in the long run. With all of that stated, regardless of what the market is doing, keep investing in your portfolio. A portfolio that grows as a result of both investment profits and regular contributions might increase rapidly. You should never let the direction of the market influence your contributions, but this is exactly what happens from time to time. Both bull and downturn markets can make you apprehensive to keep adding to your portfolio. During bull markets, great investment returns can easily persuade you that continuing contributions are no longer necessary. And during down markets, you may believe that adding to your investment portfolio is a waste of money. Both of these assumptions are entirely untrue. Contributing to your portfolio during a bull market can not only accelerate the growth of your portfolio, but will also give you additional funds for future investments. It's even more crucial to keep adding to your portfolio during a down market. If your portfolio is losing value owing to low returns, your contributions will be the only thing keeping it from falling further. Even more importantly, the fresh money you put into your portfolio will serve as capital to buy stocks at great discounts when the market is at its lowest point and then begins to rise. Consider the long term. The get-rich-quick mentality is probably the worst misconception that can influence any investor. During bull markets, it's extremely difficult to resist. Everywhere you turn, gurus claim that if you follow their plan, you may double or quadruple your money in just 1 or 2 years. Successful investment, like paying off a mortgage, creating a profession, or raising a child, takes time and patience. Your time horizon should never be measured in months or even years, but rather in decades. Over 30 years, putting $10,000 per year in an index fund with an average rate of return of 8% will yield over $1.25 million. That may not be a get-rich-quick scheme, but it is a method for becoming wealthy, and that is what matters. Overall, you'll need to take a long-term approach and retain the discipline to contribute to your savings plan each year while avoiding getting sidetracked by numerous get-rich-quick scams. You're on the correct track if you're already doing it. However, you may need to employ some of the tactics listed above to boost your investment returns. Last but not least, be consistent. Automating wealth creation is the simplest approach to do it. While you can't predict how the financial markets will perform, you can control your actions, which is the next best thing. This entails contributing to your investment accounts regularly. Your investment portfolio will grow faster if you save and invest consistently. Dollar cost averaging is a popular approach for making recurring donations, DCA. Regardless of how the markets do, you invest the same amount each month with DCA. When prices are low, you buy more shares, and when prices are high, you buy less. Over time, DCA may outperform saving a huge sum of money and then investing it all at once. More significantly, it ensures that you invest rather than spend your money. If this sounds familiar, it's because you're probably already investing in your 401k plan, as well as your IRA or other investment accounts. Do you still utilize any of these tactics, or have you noticed that they've fallen out of favor as time has passed? That's all we've got for now. If you liked what you have just watched, please make sure to give it a thumbs up. And for more videos like this, make sure to subscribe and turn on the notifications so that you will not miss any of our videos. Thank you for watching this video. This is the next financial step, and we hope to see you again soon.